If you're sitting on cash right now and waiting for the market to feel safer, this video is for you. Because on the surface, waiting can feel like the responsible thing to do. Markets are uncertain, headlines are unsettling, and it can feel reasonable to say, I'll just invest once things calm down. Here's the problem. By the time things feel calm, the opportunity has already passed, it's moved on. In this video, we're going to look at the market timing question directly, what the data shows about waiting, what it can cost investors over time, and how to take the emotion out of the decision entirely. I'm Kris Dureau from Green Private Wealth. Let's get into it. Here's the thing about waiting for the right moment to invest. The moment that feels right almost never arrives. When markets are falling, it feels too risky. When markets are volatile, waiting feels cautious. And when markets recover, it feels like you've missed the bottom and now it's too late. There's always a reason to hold off. And the difficult part is waiting usually does not feel like a mistake while you're actually in it or doing it. It feels careful, it feels patient, it feels responsible. And this is not a personal failing. It's how people naturally respond to uncertainty and when there's emotion tied into it. The problem is this instinct can keep investors on the sidelines far longer than they intend to be. And sitting on the sidelines has a real cost. Okay, so some of these points are fine and dandy, but let's look at what the data actually shows about market timing. In certain long-term market studies, missing just the 10 best trading days cuts returns almost in half. 10 days out of thousands. You'd think it's irrelevant, but it's not. It can make a huge difference. Now, the exact result depends on the market, time frame, and methodology used, but the lesson is simple. The market's best days are very easy to miss because they often happen when investors feel the least comfortable. They're not super apparent. They often happen during the most volatile, uncertain, and uncomfortable periods in the market because that is when recoveries begin, and recoveries can move very quickly. So the investor who moves to cash and waits for things to settle down can miss some of the best days that matter most to long-term returns. Now, past performance never guarantees future results, but history does show a consistent lesson. Markets have gone through wars, recessions, pandemics, inflation shocks, interest rate cycles, and, like right now, political uncertainty. Investors who stayed invested through these periods generally had a better chance of participating in the recovery than investors who tried to move in and out at the exact right time, which is called market timing, which is almost next to impossible to do correctly. Let's look at a simplified hypothetical example for illustration only. Imagine two investors. Both have $100,000 to invest. Both are planning for a 20-year investment horizon. The first investor puts the money to work today. The second investor decides to wait 1 year for things to feel more certain. Assuming a 6% average annual rate of return, the investor who started today ends up with approximately $321,000 after 20 years. The investor who waited 12 months ends up with approximately $303,000. That 1 year of waiting could cost roughly $18,000 in this very simplified example. Not because the market did anything unusual, just because one investor had an extra year of compounding and the other did not. Now stretch it out to someone who keeps waiting another 6 months, and then another, until things just feel warm and fuzzy and comfortable. The cost can grow with each delay. Time in the market is one of the most powerful variables available to a long-term investor. And every month spent waiting is a month where compounding is not working for you. Now, I want to address the obvious question. What about right now? We have geopolitical tension, we have tariff uncertainty, markets have been volatile, oil prices have been elevated, and there are plenty of headlines that make waiting feel like a cautious choice. But here's the honest answer. Right now always feels uncertain in one way or another. 2008, the global financial crisis. 2020, global pandemic that shut down economies. 2022, it was one of the fastest interest rate hiking cycles in decades. Every one of those periods felt like a terrible time to invest. And yet, for the long-term investors, those were exactly the types of periods where staying disciplined mattered the most. The question is not whether the environment feels certain. It almost never does. The better question is whether you have a plan that is designed to work through uncertainty instead of waiting for certainty before it can begin. So what does a disciplined approach actually look like in practice? For many investors, one of the simplest tools is automatic regular investing. You choose an amount that fits your situation. You invest it on a regular schedule, monthly, bi-monthly, and you make that process automatic. It could be every paycheck. It could be whatever rhythm makes sense for your cash flow. The point is that you're not waking up every few weeks trying to decide whether the market feels good enough to drop money in right now. You have already made the decision ahead of time. But the deeper benefit is psychological. Automatic investing helps remove the emotion from the decision. That's a big point. You are no longer watching every headline and asking, is today the day? You're following a process. And for many people, that's what allows them to stay consistent. Now, there's an important distinction here. If you already have a lump sum to invest, the historical evidence, the data, has often favored investing sooner rather than spreading it out. But if fear or uncertainty is keeping you completely in cash, then a staged approach may be more practical than doing nothing. And for ongoing contributions from income, regular systematic investing remains one of the most practical ways to build wealth over time. The key is not to find the perfect moment. The key is to have a process that you actually follow. Look, trying to time the market is one of the most studied and consistently difficult approaches to investing. The evidence is clear enough to take seriously. Waiting for perfect conditions often comes with a cost. The best time to invest is not when the headlines feel comfortable. They rarely do. The best time to invest is when you have money available, a clear purpose for it, and a realistic time horizon, and most importantly, a plan that fits your situation. If you want to build a stronger foundation for thinking about investing in Canada, we've put together a free resource called A Canadian Guide to Investment Basics. It covers the core concepts behind long-term investing, how to think about risk and time horizon, and how to approach putting money to work in a way that fits your life. Click the link in the description below to download your copy. And if this video was useful, give it a like, share it with someone who's been sitting on the sidelines waiting for the right moment, and subscribe for more straightforward financial content for Canadians. I'm Kris Dureau with Green Private Wealth. Thanks for watching, and we'll see you in the next one.